Hello everyone. Today we will talk about buying an existing business. The entrepreneurial journey is inherently risky, and various strategies exist to mitigate this risk. One effective approach is purchasing a franchise, as discussed in Chapter 6. However, another valuable method is acquiring an existing business, especially as many baby boomers approach retirement and seek to sell their enterprises. This context presents opportunities for buyers, as these sellers may offer their businesses at reasonable prices due to their desire to retire. Dan Stepp from the University of Houston's Wolf Center for Entrepreneurship notes that many older business owners are looking for buyers who may benefit from a streamlined acquisition process. The recent economic recession has also contributed to a buyer's market for small businesses, making it more feasible for entrepreneurs to enter the market. Nevertheless, buying an existing business necessitates careful analysis and evaluation. Rushing into a purchase out of excitement can lead to costly mistakes. Research indicates that 87% of small to medium-sized business purchases take less than a year, with an average of 6 to 8 months to finalize, emphasizing the importance of thorough research. Key considerations before making a purchase include alignment of the business with personal interests and expertise, understanding negative aspects of ownership, investigating the business's reputation and market position, scrutinizing financial records and legal standings, weighing the motivations behind the current owner's decision to sell. As highlighted by Russell Brown, existing businesses often come with a proven track record, but due diligence is critical. Entrepreneurs should ask pertinent questions about the business's viability, potential challenges, and their own capability to manage the enterprise effectively. Investing time and energy in evaluating a business can lead to successful acquisitions while preventing costly errors. Advantages of buying an existing business. Purchasing an existing business offers several key advantages that can significantly benefit an entrepreneur. Proven success. Established businesses often come with a solid customer base, reliable supplier relationships, and streamlined operations. A history of profitability increases the likelihood of continued success. New owners should make changes gradually to maintain these valuable connections. Leverage previous owners' experience. New owners can negotiate for the previous owner to remain as a consultant during the transition. This helps in maintaining client relationships and understanding the nuances of the business operations. Job security. Owning a business allows an entrepreneur to control their own destiny, reducing the uncertainty associated with employment and potential job loss in unstable economic conditions. Quick start. Buying an existing business can be a faster route to entrepreneurship compared to starting from scratch. It often comes with existing revenue streams, allowing the new owner to generate income immediately. Strategic location. An existing business in a prime location can provide a competitive edge. The benefits of a strong location are often worth more than starting a new business in a less favorable area. Established workforce and suppliers. Experienced employees and established supplier relationships are valuable assets. They can facilitate a smoother transition and provide immediate stability as the new owner learns the ropes. Functional equipment and facilities. Acquiring existing equipment allows the buyer to assess its condition and capabilities upfront. They may find significant savings compared to buying new equipment, and assess its value before making a purchase. Inventory management. Established businesses often have a well-balanced inventory, which is crucial for operational success. Understanding inventory needs can help avoid issues like excess capital tied up or unmet customer demand. Establish trade credit. Previous owners have built trade relationships that new owners can utilize, allowing for favorable credit terms from suppliers. A history of solid business dealings can ease negotiations. Easier access to financing. Lenders typically view existing businesses with a track record as lower risk compared to new ventures, making it easier for buyers to secure financing. Buyers can present a proven business history to potential lenders. Potential bargains. Some businesses may sell for less than their true value, especially if the current owner is motivated to sell quickly. Specialized or niche businesses may also present unique opportunities for negotiation at a lower price. Disadvantages of buying an existing business. While purchasing an existing business has its advantages, there are several significant drawbacks to consider. Cash requirements. Acquiring an existing business often entails a higher upfront cost than starting a new venture due to established customer bases, brands, and operational systems. Potential losses. A business may be for sale because it is losing money or has never been profitable. Previous owners may have used accounting tricks to present a misleading financial picture. New owners must conduct a thorough analysis to uncover hidden issues. Inheriting problems. Buyers may face unforeseen challenges like poor supplier relationships, legal issues, or declining customer goodwill. These problems often remain undisclosed prior to sale and can have long-lasting impacts. Unsuitable employees. Existing employees may not fit the new owner's vision or management style. This can necessitate difficult personnel changes, potentially leading to resentment and decreased productivity. Unfavorable location. A previously ideal location may become less desirable due to demographic shifts, competition, or changed traffic patterns. Assessing market trends is vital before making a purchase. Obsolete equipment. Without proper evaluation, buyers might inherit outdated or inefficient equipment, leading to increased operating costs. Upgrading facilities can be a significant financial burden. Customer loyalty issues. Customers may have strong loyalties to the former owner, making retention challenging. This is particularly problematic in service-oriented businesses where personal relationships play a key role. Implementation of change. Established practices can create inertia, making it difficult for new owners to implement necessary changes. Past agreements or policies can limit flexibility in operations. Obsolete inventory. Inventory on the books may not reflect its true market value. Buyers should verify the salability of inventory to avoid overpaying for assets that are no longer viable. Valuing accounts receivable. Accounts receivable often aren't worth their face value. Aging these receivables can provide a clearer picture of collectability, preventing financial misjudgments. Overpricing. Many buyers purchase businesses at inflated prices. Understanding the true value of assets can help negotiate a more favorable price, ensuring profitability. Complexity and time. The process of buying an existing business can be lengthy and labor-intensive, with many deals failing to meet expectations. Thorough analysis and preparation are crucial to avoid potential pitfalls. Stages of buying a business. When entrepreneurs embark on the journey of buying a business, they typically navigate through three key stages: the search stage, the deal stage, and the transition stage. Each of these stages involves specific processes and considerations that are crucial for making informed decisions. In the search stage, The first step is to conduct a self-inventory. Entrepreneurs must evaluate their interests, skills, and personal goals by answering key questions such as what business activities they enjoy and what industries captivate them. This self-assessment helps define the type of business that would be a good fit. Following this, they develop a list of key criteria that the ideal business should meet, which allows for a targeted approach in finding potential opportunities. Next, entrepreneurs search for potential acquisition candidates using various resources. This includes online platforms, networking with industry professionals, and engaging with business brokers. Once a list of potential businesses is established, the next critical step is to conduct thorough investigations to evaluate their viability. This often requires signing a confidentiality agreement to access sensitive financial information and operational details. The investigation process itself encompasses three main areas: researching the customer base, conducting a competitor analysis, and understanding the seller's motivation. Analyzing the customer base involves assessing who the customers are and their buying habits to gauge loyalty and demand. Competitor analysis provides insights into the business's market position, identifying strengths, weaknesses, and overall competition. Additionally, understanding why the seller is selling the business is vital. Common motivations include financial distress, personal reasons, or knowledge of impending market changes that may affect the business's future. Finally, buyers must conduct a detailed financial review after an NDA is signed. This involves examining financial statements from the past 3 years to assess business health and profitability. This thorough preparation in the search stage lays the groundwork for moving into the deal stage, ensuring that entrepreneurs make informed and strategic decisions as they proceed with the acquisition process. The deal stage. After identifying a specific business to purchase, the next step for entrepreneurs is to enter the deal stage. This critical phase involves several key processes: valuing the business, arranging financing, negotiating the purchase details, signing a letter of intent, and conducting thorough due diligence. Each of these steps is vital for a successful transaction. Valuation is a pivotal part of this stage and can significantly impact whether a deal proceeds. It is important to recognize that many deals fail due to a mismatch between the seller's asking price and the buyer's assessment of value. Various factors contribute to this complexity, including market position, earning capacity, and intangible assets like goodwill. Additionally, the median selling price of a private company can vary widely, making it essential for buyers to understand different valuation methods. Determining the value of a business involves both objective measures and subjective considerations. For tangible assets, valuation is typically straightforward, but intangible assets, particularly goodwill, can be more contentious. Sellers often equate goodwill with their personal effort and pride in building the business, while buyers focus on what these intangible assets can generate in future income. To navigate this, buyers should employ multiple valuation techniques to gain a comprehensive view and avoid relying solely on simplified rules of thumb, which can mask the intricacies of pricing the business. 3 primary methods can be employed for valuation: the balance sheet method, the earnings approach, and the market approach. The balance sheet method focuses on calculating the net worth or owner's equity by evaluating total assets minus liabilities. While this method provides a quick estimate, it often oversimplifies reality and does not account for intangible assets or future earnings potential. An adjusted balance sheet technique offers a more accurate view by taking into consideration the current market value of assets. In contrast, the earnings approach is favored for its focus on future income potential, which is what buyers are ultimately acquiring. Within this approach, the adjusted earnings method allows buyers to calculate the business's true earnings by analyzing EBITDA, earnings before interest, taxes, depreciation, and amortization, and making necessary adjustments. This method can yield insights into how much the buyer could expect to earn in the future, fundamentally determining the business's worth. Another variation, the excess earnings method, combines tangible asset value with the expected future earnings to estimate the business price. This method is beneficial because it provides an estimate of goodwill based on the business's established reputation and customer base. However, buyers should scrutinize any goodwill adjustments presented by sellers, as these can often be inflated. The excess earnings method is a valuable approach for determining the value of goodwill during a business acquisition. This method quantifies goodwill based on the profits a business generates above the average earnings of similar firms in the industry. Additionally, it assumes that the owner is entitled to a reasonable return on the company's adjusted tangible net worth. This systematic process involves several steps that can guide buyers toward a fair valuation. To begin, the buyer calculates the company's adjusted tangible net worth by subtracting total liabilities from total tangible assets, which should be adjusted for their market value. For example, in the case of Keiper Electronics, the adjusted tangible net worth is obtained by subtracting $114,325, the company's total liabilities, from $279,738, total assets, resulting in an adjusted net worth of $165,413. This figure serves as a foundation for further calculations. Next, the buyer must consider the opportunity costs of the investment. This involves identifying the potential earnings foregone by investing in the business instead of in other opportunities. The opportunity cost includes both the potential investment returns and the salary the buyer could have earned in alternative employment. Typically, the rate of return encompasses a risk-free component, an inflation premium, and an additional risk allowance. In the Keiper Electronics example, a 25% return on the adjusted tangible net worth results in an opportunity cost of $41,353. When adding the foregone salary of $75,000, the total opportunity cost amounts to $116,353. After determining opportunity costs, the next step is to project the company's net earnings for the upcoming year. The buyer must examine past earnings trends to make accurate projections, ensuring that the estimates reflect any necessary adjustments. For Keiper Electronics, the adjusted net earnings are projected to be $195,000, which includes the anticipated owner's salary. The next calculation involves determining the company's extra earning power, defined as the difference between the projected net earnings and the total opportunity costs. In the case of Keiper Electronics, this calculation yields $78,647 in extra earning power, arrived at by subtracting the total opportunity costs from the projected net earnings. This figure becomes essential for estimating the value of intangible assets. To estimate the value of intangible assets, the extra earning power is multiplied by a years of profit figure, which usually falls between 3 to 4 for normal risk businesses. For Keiper Electronics, A calculated years of profit figure of 4.1 results in a value of intangibles at $321,141. This step highlights the significance of goodwill in a company's valuation, capturing its potential beyond tangible assets. Lastly, to determine the overall value of the business, the buyer combines the adjusted tangible net worth with the value of the intangibles. In the case of Kuiper Electronics, this sum is $165,413, adjusted tangible net worth, plus $321,141, value of intangibles, yielding a total business value of $486,554. Both the buyer and the seller must take the tax implications into account, especially regarding how goodwill is treated. Buyers can amortize the cost of goodwill, while sellers often prefer to have more of the purchase price attributed to goodwill due to the favorable capital gains tax treatment it offers. The discounted future earnings approach consists of 5 key steps designed to estimate a company's value based on its future earnings potential. The first step involves projecting earnings for the next 5 years. One effective way to do this is by developing 3 forecasts: pessimistic, most likely, and optimistic, and then calculating a weighted average. The formula used weighs the most likely forecast 4 times more than the other 2 forecasts, ensuring a balanced perspective that accounts for uncertainty. For Kuiper Electronics, the buyer sets earnings projections based on this method, while noting that accuracy decreases as the forecast extends further into the future. The second step requires discounting these projected future earnings using an appropriate present value factor. This factor can be sourced from published present value tables or calculated using the formula. Next, the buyer must estimate the income stream that will extend beyond 5 years. A common technique involves multiplying the estimated income from the 5th year by a factor of. The fourth step is to discount this future income estimate back to its present value, using the present value factor for the 6th year. For Kuiper Electronics, this calculation yields a present value of $166,898 when the future income is multiplied by the appropriate discount factor. Finally, the total business value is computed by adding the present value of the projected earnings for the first 5 years to the present value of the income beyond that period. For Kuiper Electronics, this brings the total valuation to $527,929, showcasing the comprehensive nature of this approach. The primary advantage of the discounted future earnings method is its strong focus on future earnings potential, which is especially useful for valuing service businesses or those experiencing rapid growth. However, the reliability of this approach heavily depends on the accuracy of the earnings forecasts and the appropriateness of the selected present value factor. In contrast, the market approach utilizes price earnings, PE, ratios of similar businesses to establish a company's value. This involves averaging the PE ratios of comparable publicly traded companies and applying this average to the estimated earnings of the private company in question. For example, if the average PE ratio of similar companies found was 4.025, multiplying this by Kuiper Electronics' estimated earnings of $120,000 results in a corresponding value of $483,000. While the market approach is straightforward and intuitive, it does have significant drawbacks. The comparison between publicly traded and privately owned companies often leads to challenges due to the illiquidity of private stocks and the potential subjectivity of the applied PE ratios. Moreover, private companies may underreport earnings to minimize tax burdens, further complicating accurate valuation. Finding truly comparable publicly held companies can also be difficult, limiting the effectiveness of this method. Additionally, ensuring that after-tax earnings from a private company align with the P/E ratios derived from public companies is essential for valid comparisons. Ultimately, there is no single best method for determining the value of a small business. Each technique can produce a range of values, and buyers are encouraged to seek clusters of values that make sense within the context of the business and its specific circumstances. The final purchase price will be influenced by both the chosen valuation method and the negotiation skills of the parties involved. In essence, a business's value is subjective and rooted in what the highest bidder is willing to pay under terms that are acceptable to the seller. Once an entrepreneur has determined a reasonable value for the business they wish to purchase, the next critical step is negotiating a suitable deal. Many buyers overlook that the price they ultimately pay for a company is often less critical to its ongoing success than the terms of the purchase. The structure of the deal, including the terms and conditions of payment, is significantly more vital than the actual purchase price. While buyers should strive for the best price, their primary focus should be on negotiating favorable terms that ensure the deal does not jeopardize the company's future financial stability or cash flow. At first glance, the negotiation process may seem purely adversarial, with both parties pursuing conflicting objectives. However, successful negotiations can foster a cooperative relationship built on trust and honesty. Both buyer and seller must articulate their positions while seeking to understand each other's perspectives. A collaborative approach can keep discussions productive and dynamic, enabling both parties to achieve their goals through necessary compromises. Preparing for negotiations involves setting clear objectives, which should be prioritized. By ranking desired outcomes, both parties can enhance the likelihood of achieving their goals. This method allows each side to identify which terms are negotiable and which are non-negotiable. If the seller insists on a particular term that the buyer cannot accept, the seller can explain their reasoning and propose a concession in return. This mutual understanding and flexibility often prevent negotiations from stalling. In the negotiation process, both parties must recognize that arriving at an agreement benefits them both. They should strive toward consensus while being open to making concessions that keep discussions constructive. For instance, if a buyer wishes to purchase the business for $900,000, but the seller has a minimum acceptable price of $1 million, they must find common ground within the bargaining zone between these limits. Effective communication and an understanding of each party's position will be instrumental in reaching an agreement. Successful negotiations are built on a foundation of trust. Establishing a rapport between the buyer and seller can set a positive tone. Both parties should have a clear understanding of what they want to achieve, articulating their ideal outcomes. While the perfect deal may not be attainable, identifying the most critical issues helps guide negotiations. A well-thought-out negotiating strategy is crucial for success. Buyers should avoid entering negotiations with a vague approach. Instead, they should prepare for various scenarios. Starting off with an open-ended dialogue allows the other party to set the initial price, creating a more natural negotiation flow. Moreover, understanding and empathizing with the other party's needs contributes to finding solutions that satisfy both sides. Maintaining focus on the issues at hand rather than personal attacks is essential to preventing conflicts from derailing negotiations. This objective mindset helps cultivate an atmosphere where both parties can work collaboratively toward a mutually beneficial outcome. Recognizing the other side as partners rather than adversaries fosters a more cooperative spirit. Effective negotiators also prioritize patience, especially when dealing with emotionally charged transactions, like the purchase of a long-established business. The seller's personal attachment to their company can complicate the negotiation process. Being prepared to walk away from a deal that does not align with your goals is important. Understanding that no deal can be a viable option protects the buyer from unfavorable agreements. In any business acquisition, the buyer typically has several key goals that guide their negotiation strategy. First and foremost, they aim to acquire the business at the lowest price possible. This goal is often driven by a desire to maximize potential returns on investment and minimize financial risk. Another critical objective is to negotiate favorable payment terms, ideally allowing for payments to be made over time. This approach can ease the immediate financial burden on the buyer and help maintain cash flow during the early stages of ownership. Buyers often seek to minimize the cash outlay up front, making it easier to manage ongoing operational costs and investments in the business. Moreover, buyers look for assurances that the business they are purchasing aligns with their expectations. This includes confirming the accuracy of financial records, understanding the customer base, and verifying any claims made by the seller regarding the business's performance and potential. Buyers want to ensure that all representations made during negotiations are truthful, thus protecting their investment. Additionally, preventing the seller from establishing a competing business after the sale is a significant concern. Buyers often negotiate for non-compete clauses to ensure that the seller does not leverage their experience and knowledge to undermine the buyer's new investment shortly after the transaction. Understanding the seller's goals is crucial for any buyer looking to negotiate a successful business acquisition. For many entrepreneurs, their business represents not just a financial investment, but a significant part of their identity. These individuals may have nurtured the business from its inception, pouring their time and energy into its growth. As they prepare to sell, they often grapple with profound questions about their future. What will they do without their business? How will they define themselves now? Recognizing these emotional aspects is essential, as it guides the buyer to negotiate with sensitivity and respect. Broadly speaking, sellers typically seek to achieve several primary goals during negotiations. Foremost among these is obtaining the highest possible price for their company. This objective is often tied to the seller's personal investment in the business and the sacrifices made throughout its development. Additionally, sellers wish to sever all responsibility for the company's liabilities, ensuring they are not held accountable for any future obligations. They also want to avoid unreasonable contract terms that could limit their future opportunities or create burdens. Maximizing the cash received from the sale is another key priority, accompanied by minimizing the tax burden associated with the transaction. Sellers are particularly concerned with how capital gains taxes may affect their take-home amount. Finally, they seek assurance that the buyer will fulfill all future payment obligations, as sellers often provide financing terms in the deal. To facilitate a successful negotiation, both parties must structure the deal in a way that satisfies their respective goals. A straight business sale is one common method, typically preferred by sellers wishing to step down from the company completely. Studies have shown that the majority of business sales are asset sales, wherein the seller retains liability for any outstanding debts or potential future claims, making this option attractive to many buyers. In a straight business sale, around 94% of transactions involve asset sales, while only a small fraction represents stock sales. Payment structures often include a cash component, with many deals featuring a down payment followed by a seller-financed note to cover the remainder. While selling the business outright can be the most straightforward approach, it may not be the most financially advantageous for sellers who want to minimize tax implications or those who wish to maintain some level of involvement in the business post-sale. Another option is to explore alternative financing arrangements, especially when traditional lenders are hesitant to finance the purchase. Often, the seller can play a crucial role in financing the deal through a seller finance note, allowing the buyer to make regular payments over time. This arrangement can include a down payment that covers 20 to 70% of the purchase price, with the remaining balance financed over a period of 3 to 10 years. It is vital for both parties to agree on terms that do not jeopardize the company's cash flow, ensuring the buyer can meet these payment obligations. For sellers who prefer to maintain control of the business during the transition, a two-step sale can be a suitable solution. In this arrangement, the buyer acquires a portion of the business up front, typically between 20 to 70%, with the agreement to purchase the remainder at a later date. This structure allows the seller to retain partial control and can provide both parties with the security and flexibility they need during the transition. Once the buyer and seller agree on the details of the business sale, they formalize this agreement in a letter of intent, LOI. This document serves as a commitment from both parties to proceed towards closing the sale. Key components of the LOI include stipulated price, the agreed-upon price and any factors impacting the final closing price. Sales structure, clearly indicating whether the transaction is an asset sale or a stock sale, including details about owner financing, specific deal points, any other essential terms that are significant to either party. Closing timeline, define dates by which the transaction should be completed. Despite this commitment, it's notable that only about 25% of deals advance from the LOI to the final closing. The sentiment that the devil is in the details underscores the potential challenges during due diligence and when preparing closing documents. The due diligence process. Due diligence is a critical phase in the acquisition process, involving a thorough examination of all relevant information to verify what is being purchased and to avoid unforeseen issues post-sale. Key aims of due diligence include confirming valuation, assessing the true value of the business assets, legal issues, identifying any known or hidden legal risks, financial condition, evaluating whether the business is financially sound. Confirming valuation. The prospective buyer must critically evaluate the business's assets to ascertain their real value, moving beyond the financial statements provided by the seller. Important considerations include asset utility. Are the assets functional, or are they outdated? Replacement needs. Will any assets require replacement soon? Operational efficiency. Are the assets operating efficiently? A physical inspection of all equipment and infrastructure is essential, even for assets not included in the sale price. Engaging professionals for evaluations, such as structural assessments, can help uncover potential renovation costs that might impact the buyer's budget. Key areas to investigate. Accounts receivable. Assessing the quality and collectability, such as determining how many accounts are past due and their creditworthiness. Lease arrangements. If the business operates from a leased property, It's crucial to understand the lease's terms, expiration, and any potential restrictions imposed by the landlord regarding renovations or continuation of the lease post-sale. Business records. The accuracy and comprehensiveness of the seller's business records are invaluable. A potential buyer may need to reconstruct records if the seller's bookkeeping is inadequate. Current customer lists can be particularly beneficial for future marketing efforts. Intangible assets. Identifying valuable intangible assets such as trademarks, copyrights, or goodwill is vital, as these can significantly enhance the total business value. The value derived from relationships, knowledge, and intellectual property often surpasses that of tangible assets. Location and appearance. The physical location and condition of the business premises matter greatly in attracting customers. Buyers should investigate local zoning laws to ensure their plans for the business align with regulatory requirements. The transition stage. After successfully closing the purchase, the transition stage begins. This stage is critical, as it involves integrating the new ownership into the existing business framework. Closing the sale itself is a complex legal process, and many transactions stumble at this final hurdle due to unexpected challenges or last-minute changes from either party. Key closing documents. The closing process typically involves a variety of important documents, which may include asset purchase agreement, the formal contract detailing the sale, bill of sale, a document that formally transfers ownership of the business, asset list, a comprehensive list of all assets included in the sale, both tangible and intangible, buyer's disclosure statement, information provided by the buyer about their plans or financial status, allocation of purchase price, a document required by the IRS that allocates the purchase price among various assets for tax purposes, non-compete agreement, ensuring the seller does not start a competing business, consulting/training agreement, an arrangement for the seller to assist the buyer post-sale, transfer of subsidiaries, documentation for any subsidiaries related to the business, transfer of utilities, ensuring services are transitioned smoothly, website and social media transfers, transition of digital assets and accounts, new entity documentation, paperwork for the new entity owning the business and its bank accounts, transfer of merchant accounts, ensuring payment processing setups are in place, notice to creditors, informing creditors of the business change, lease assignments, ensuring leases are transferred appropriately, financing documents, if seller financing is involved, including promissory notes and security agreements, sales tax and payroll tax clearance, documentation ensuring no outstanding tax issues, escrow instructions, guidelines for managing funds and transactions, closing adjustments/proration, adjustments to account for expenses incurred during the sale, transfer of third-party contracts, ensuring all contracts associated with the business are upheld, corporate resolution, authorization for the sale of corporate assets, facilitating a smooth transition. Despite thorough planning, the transition phase can introduce surprises and emotional challenges. Here are several strategies to help ensure a smooth transition. Communicate with employees. Clear communication is crucial. Employees may feel uncertain and anxious about changes, so it's important to explain your vision for the company and how it will affect them. Be honest. Transparency fosters trust. Avoid sugarcoating issues. Instead, provide truthful answers, even if they're not what employees want to hear. Listen to employees. Employees provide valuable insights into the business's strengths and weaknesses. Encourage an open-door policy to gather feedback and suggestions. Engage key stakeholders. Take the time to share your vision with key stakeholders, including major customers, suppliers, and financial partners. Building these relationships early can help establish trust. Consider a consultant. Ask the previous owner to serve as a consultant during the transition. Their knowledge and experience can guide you through potential pitfalls and provide continuity.
Thank you for watching. If you liked this video, please like and subscribe to channel.